Good morning and welcome to today's webcast, Help Reduce Financial Reporting Pitfalls During COVID-19. We will be saving time at the end of the webcast to answer your questions. To ask our presenters a question, please type it in the Q&A window and click Submit. If we don't have time to answer your question, we will do our best to follow up with you after the webcast. In addition to today's presentation, Moss Adams has many resources to help you navigate COVID-19. You can find links to these resources in the slide deck and handouts widget to the left of the slide view. Finally, the material appearing in this presentation is for informational purposes only and should not be construed as advice of any kind, including, without limitation, legal, accounting, or investment advice. I'm pleased to introduce today's presenters from Moss Adams. Aparna Venkateswaran, Senior Manager in our hospitals practice, and Brian Connor, Partner in Charge for our Sacramento and Stockton offices and National Practice Leader in our hospitals practice. And with that, I will turn it over to Brian to get us started.
Great, Emily. Thank you very much. I appreciate that introduction and welcome everybody. I understand we have close to 400 participants registered this morning and you don't get any CPE, so that must mean that you're actually interested in the content we have here today, which is very exciting. So we're going to cover a number of things related to COVID, questions we've been getting and thoughts on accounting for various different programs. You can see here on the agenda. We'll start with the Provider Relief Fund. I know there's plenty of questions on how to account for that, and we'll go through that from a different entity type perspective. As well, we'll cover the Fema Public Assistance Program, Medicare Accelerated Advance Payment Program, PPP loans, temporary increases in CMS payments, and then we'll throw in some other accounting considerations, questions that we've heard, and things that may be affected based on what everybody's going through now. And as Emily mentioned, we've got hopefully some time here at the end for some Q&A. So we're suspecting that this agenda may not cover all the accounting and financial reporting questions that the folks have out there. So if we're not covering something that you want to hear about, or you have questions on what we have covered, don't hesitate to use the Q&A feature, and we'll either address that here on the webcast or get back to you outside the webcast. So let's go ahead and get started. I think we're going to start off, Emily, here with a polling question just for.
Yeah, so we are going to have a couple of polls throughout today's presentation. And our first one, what type of entity is your organization and what is the basis of accounting? And your options are A, a for-profit private entity, FASB reporter, B, not-for-profit entity, FASB reporter, or C, governmental entity, GASB reporter. And I'll give everyone a few moments to respond. To participate in our polls today, please click the button next to the answer you choose and hit Submit. I'll give everyone just a couple more seconds. All right, let's go ahead and take a look at the results. Brian, back to you.
Excellent. Thanks, Emily. Well, we've got, as we had expected and maybe hoped, we've got kind of a range of reporters here today. So we will cover these accounting questions from both a FASB, private entity and NFP perspective, and a GASB perspective. Try and cover all of those. Great, thanks for that. Let's go ahead and get started and talk about kind of what's foremost on everybody's mind, the Provider Relief Fund. So as you know, there's been about $50 billion in general distribution payments allocated to date. So we're going to talk about accounting for those general distribution payments. There's obviously a number of other tranches in that Provider Relief Fund that are being allocated, are going to be allocated, that are maybe a little bit more narrow or specific. So we're not going to cover those here today. Just talk about the general distribution payments that have been allocated to date. And there are some nuances with the different entity types. We saw in the poll we've got a spectrum of entities here, and the accounting will be a little bit different between NFPs, private companies, and governments. So we'll go through that. We're not going to cover the public registrants, the SEC. We do have, a few thoughts. If you have some registrants on the phone and you have questions, let us know, or on the webcast, and we can give a few thoughts there. But we're primarily going to focus on the other three entity types here. Go through accounting topics like timing and amount of revenue recognition, classification, and disclosure. And we're also going to cover here right out of the gate single audit implications, which I think is important. There's a really good chance that these funds will have single audit implications for all types of entities. We'll touch on that as well. And to kick us off here, I'll turn it over to Aparna to talk about not-for-profit organizations and start with some single audit implications. Aparna?
Yes, thank you, Brian. Good morning, everybody. So with the single audit, as Brian mentioned, it is very likely the Department of Health and Human Services did put on sam.gov, which is where the information is typically available about programs or federal funds that may be subject to audit. So they have indicated that it's likely that these funds will be subject to audit. However, beyond that, there's not really any guidance or clarity. So, per the AICPA expert panel information we're getting from there, right now there's just more questions than there are answers. One of the concerns, really, from a practical standpoint, is the OIG is definitely concerned about the flood of filings that will happen, because there's likely to be at least 4,000 to 5,000 additional reports that may be submitted if the single audit requirement is held to be required. And so there's just not a lot of clarity on how that's going to play out. At this point, it is probable and it is possible, I'll say it both ways, that the single audit requirement may apply, and the threshold for that is for those non-federal entities that have received or expend over $750,000 or more, they would be subject to the audit. So at this point, again, we're expecting more guidance in September of this year, and part of that guidance will be both on the single auditee side, what are the compliance requirements, what is the documentation that needs to be maintained, and all of that related information. And then on the other side, also allowing the auditors to understand what are the compliance requirements that need to be audited and how does the single audit need to be performed. Once that guidance comes out, hopefully there'll be more clarity. The other piece of information related to this is if the single audit is required, there will be 9 months after fiscal year end for providers to get the single audit completed. So if there is a little bit of time between now and hopefully September for organizations to hopefully get prepared for this and get moving on it if the single audit is required. So moving forward, we're going to start by taking a look at, as Brian had also mentioned, the different entities, the types of organizations, and how the accounting will work. And so we'll start with the not-for-profit entities. And generally speaking, the provider relief funds, they do meet the definition of a non-exchange transaction under ASC 958-605. There's really and the way that comes about is because there's no direct benefit directly to the resource provider. So these are funds that are being provided to help, supplement the lost revenue or the extra expenses that the organizations have incurred. So it doesn't meet the definition of an exchange transaction under Topic 606. And so the key here is that the entity must have incurred, healthcare-related expenses, or they lost revenue due to COVID. And there's also a restriction in terms of these funds, and that these payments can only be used to prevent, prepare, or respond for COVID-19 related information. So those are the, as you see on the slide here, we're talking about that. And there is a provision for recoupment. So, the idea around these funds generally is that, they shouldn't be recouped, but as the funds that come in are matched up against either the expenses or the lost revenues, if there's potentially any excess left over, there is a possibility that those funds could be recouped back or paid back to HHS. So that's why the accounting would be under a non-exchange transaction and recorded as a contribution model where you'd have the donor-imposed conditions and the restrictions that need to be considered in how that's accounted for. More specifically here, taking a look at just the timing and amount in recognition, because there are those conditions and restrictions I just talked about, obviously the revenue would be recognized as those conditions and restrictions are met. And so it's going to be kind of a simultaneous release, basically, because as that revenue is matched up against those expenses or lost revenues, and those conditions and conditions have been met, restrictions released, and then you can move on to recognize the revenue. Likelihood, in terms of classifying this revenue on the statement of operations, generally there is flexibility with the FASB not-for-profit model. So the key will be checking your existing accounting policies. We're typically seeing, in terms of some of the questions we've answered with clients, that it's likely going to fall into other revenues. It is definitely not net patient service revenue, so it wouldn't be appropriate to classify these funds there, but it's likely going to be other revenues within the operating section. And then in terms of the balance sheet treatment, again, as the restrictions are released and the conditions are met, those funds could be released from restriction and reflected as unrestricted on the balance sheet as well. And so going forward in terms of disclosure, for those folks that have quarterly reporting, for the March 31 reporting, this would be shown as type 2 subsequent events. It's just disclosure. There's nothing recognized in the financial statements in terms of dollar amounts. All right, and I believe, Brian, this is back to you.
Perfect. Thanks, Aparna. So let's talk about private companies. And the accounting is actually going to be similar here for private companies to what Aparna talked about for not-for-profit organizations. The provider relief funds are a non-exchange transaction. Again, the key to that is there's no direct benefit to the resource provider. If you recall, from a not-for-profit perspective, there was some clarity guidance that was issued just a couple of years ago, kind of discussing that exchange versus non-exchange determination. You know, the concept that if a resource provider gives a recipient funds, and those funds are for the general public benefit, or some kind of broad benefit, but not direct and equal value to the resource provider, that's a non-exchange transaction. Similar here for private companies. So it doesn't fall under Topic 606, and it's a non-exchange transaction. And for private companies, there's really no explicit U.S. GAAP for that. And so you're in kind of a series of models that you can evaluate for how to account for the non-exchange funds from a governmental entity. And the way that works, there's a framework that's defined in the FASB codification, Section 105, when you don't have explicit U.S. GAAP to refer to. And in those circumstances, what you do is you work through a framework where you evaluate whether there's any other U.S. GAAP that you can apply by analogy. And if you don't find that that's the case, then you look to other non-authoritative guidance that you can work through. So in that waterfall, you have some options. Of course, we just talked about the not-for-profit guidance that's out there. So private entities might be able to apply that by analogy. That's in U.S. GAAP. You also have the gain contingency model out there in ASC 450. And then finally, we have International Accounting Standards 20, which is really on point. It talks about, for international accounting standards, how you account for government grants as a private entity. So if you work through and you determine, hey, the not-for-profit standards and model really doesn't apply to me, nor does the gain contingency model, then you end up in IAS 20, which is a pretty popular model for these types of transactions. And I imagine a lot of private companies will be using that. models will be similar, I imagine, especially the not-for-profit model compared to IAS 20. It's very similar, as we'll talk about. Gain contingency model might be a little bit more conservative. You really have to have all the I's dotted and the T's crossed in order to recognize that revenue. So it's possible under the gain contingency model you'd recognize it a little bit later. But I expect most of these models will be pretty similar in terms of recognition for private companies. So for IAS 20, what you're looking for, again, it's similar to what Aparna described from a not-for-profit perspective. IAS 20 talks about, I should mention before I get into this, you also want to look at your existing accounting policy, because you may have dealt with this with the high-tech funds. So as a private company, you might have an existing policy out there. And if you chose a policy for the high-tech funds, the EHR funding that was out there several years ago, that might be appropriate. That might be your policy, and you continue with that. But you'll want to evaluate that. So when you're looking at these funds, the guidance in IAS 20 would require reasonable assurance that, one, you're going to comply with the conditions of the grant and that the grant is collectible. Obviously, collectability here is not an issue. So you're really focused on compliance with conditions. And as Aparna talked about, and reasonable assurance for IAS 20 is really equal to or consistent with the concept of probable in U.S. GAAP. So when you're thinking about these conditions, you look at the frequently asked questions on the HHS website. The definition of COVID-related expenses or healthcare-related expenses for COVID and of lost revenues is really, really broad. And HHS has expressed an intent to keep that way. So you have a lot of flexibility here, I think, in evaluating your compliance with the conditions, even though things like lost revenues haven't been drilled down and comprehensively defined at this point. So a lot of questions you get are, if I have lost revenues, or my revenues are down compared to last year so significantly that I've got a tremendous cushion between that and what I'm getting from the provider relief funds, do I meet the conditions? And, given, say, if you're a June 30th reporter, you've had a couple of months to take a look at this, evaluate it. You've got significant cushion in lost revenue, for example. It's likely you've already certified in the system. It's likely that or there's a good chance you're going to meet these conditions, and you would be able to recognize revenue. So for private companies in the IAS model, it's a two-system model where you have a capital grant model and an income grant model. You'd be looking at the income grant model, and in that, the IAS 20 does allow a systematic basis or recognition of revenue on a systematic basis over the periods in which the entity recognizes expenses for the related costs for which the grants are intended to compensate. So you do have a little bit more flexibility in the IAS 20 model in terms of recognizing revenue over a period of time as opposed to at a point in time. On the not-for-profit side, once you meet the conditions, you're recognizing the revenue. The IAS 20 model gives you a little bit more flexibility to recognize it over a period of time that you determine that you're incurring the costs that those grants are intended to compensate. So from a timing and amount of recognition perspective, we talked about the concept of evaluating when conditions are met. Again, I think that's one of the biggest questions out there. There's obviously more guidance to come from HHS, but we talked about some of those factors that would go in to evaluating that. It's a facts and circumstances thing for organizations, but I don't know, under these models, you don't have to wait until HHS has issued every last regulation to get to the perspective that you have reasonable assurance that you're meeting those conditions. From a classification perspective, IAS 20 does allow you to consider the possibility of offsetting expenses. So you can recognize the PRF funds as, you have the option of looking at that as revenue or as classification offset to associated expenses. That's really an accounting policy determination for each organization. But you do have that flexibility in this model. And from an operating versus non-operating perspective, just like not-for-profit accounting, you're going to have flexibility there. You have the ability, it's not as prescriptive, say, as we'll talk about with GASB. So you have the ability to make a determination of whether that's operating or non-operating. I would expect most organizations would consider that to be operating. So you're likely seeing that end up in an other operating revenue category, as Aparna said, with similar to not-for-profit accounting. And balance sheet treatment, there's not much there. You're really looking at a refund liability until you meet the conditions, or if you determine that there are amounts that are in excess of the amounts that you would be entitled to, those should be classified as a refund liability. And that would be the case if, again, another important consideration is, do you have other funding coming in that's offsetting lost revenues or expenses? You have to consider that in terms of meeting the conditions for retaining those funds. So if you're in a circumstance where you have some excess funds, that's a refund liability. And similar to not-for-profit organizations, anything, if you have quarterly reporting or annual reporting as of March 31st, the PRF funds are a Type 2 subsequent event, so you're not rolling that back into. Okay, so let's talk about governmental entities here. We've covered not-for-profit and private companies. So for governmental entities, and I know we have a number of GASB reporters as participants on the webcast here. Very similar to the other two, you're talking about a non-exchange transaction, a voluntary non-exchange transaction under GASB 33. Unlike not-for-profit and private companies that are FASB reporters, GASB has issued a technical bulletin that covers a lot of the stuff. It's currently in exposure draft format. It's GASB Technical Bulletin 2020-A. So GASB has a mechanism with their technical bulletins where they can actually address these kinds of things more quickly. FASB doesn't have that same kind of mechanism, so it's great that GASB has gotten that out there that directly addresses and provides guidance on a number of these items that we'll be talking about here. So you want to check that out. It is an exposure draft format, but it's going to move pretty quickly. I think comments are due within a week or so. So it's great that GASB is able to do that, unless, of course, they're telling you something you don't want to hear, which is likely. And in that case, then so great. But that's that. So from a revenue recognition standard perspective, again, you're looking at a voluntary non-exchange transaction because the government receiving value, you're receiving value without directly giving equal value in return to the resource provider. And the revenue will be recognized when all applicable eligibility criteria are met. So when you think about voluntary non-exchange transactions and eligibility criteria, they're very similar. The definition of an eligibility criteria is very similar to the definition of a condition under not-for-profit and private company guidance. So you're really looking at the same kinds of evaluations in terms of whether you're meeting the lost revenue and COVID expenses criteria there. So let's talk about timing of recognition and classification, because that will be, I think, significant here as you think about where you're putting this from a GASB perspective as opposed to when you're recognizing it. We talked about the eligibility criteria. That kind of concept is going to be very similar to evaluating the conditions that we talked about earlier. So, it's likely that in many cases you will have met the eligibility criteria here as you've received the funds or shortly thereafter. If you're evaluating meeting that eligibility criteria as of 6/30, again, it's facts and circumstances for each organization, but given the broad definitions of those, there's a good chance that those will be met as of a 6/30 reporting period. But the classification is there's some significant differences there. First of all, this is non-operating for GASB purposes. So that is explicitly addressed in GASB Technical Bulletin 2020-A. Again, that's just an exposure draft, but they kind of confirm what the guidance would suggest, GASB principles would suggest. And just unfortunately for GASB reporters, the GASB operating versus non-operating model is just much more prescriptive than FASB, and it's kind of a cash flow mirroring model where you would your classification in the statement of revenues and expenses should mirror your classification in the cash flow statement. So what's operating on the statement of revenues and expenses would be what flows into the operating category on the cash flow statement. And for just about every non-exchange transaction that's out there, those would flow into, by guidance, those would flow into a financing bucket, a capital or non-capital financing bucket. In this case, for the cash flow statement purposes, it's going to be a non-capital financing activity. And then that leads you down the road to a non-operating classification on the statement of revenues and expenses. So I think that's going to be an unpopular answer there for GASB reporters. But again, that's pretty explicit in the technical bulletin that was issued. The question has come up a number of times of, what do we do with expenses? Can you offset expenses? Or, for example, can you take, if you're using those PRF funds for COVID-related expenses, can I take that portion and offset the expenses that I'm incurring, or can I pull those expenses out of the expense category and roll those down into non-operating to be consistent where I'm putting the PRF funds? And the answer to that question is no, based on GASB principles and the technical bulletin. Those expenses are operating expenses, and the PRF funds are non-operating funds, unfortunately. The technical bulletin also addressed extraordinary or special treatment that GASB 56 provides for a concept of something that's extraordinary or special. You would have a separate category and pull that down below the other line items in the statements of revenue and expenses. And for extraordinary classification, that's kind of feeds off the classic FASB guidance when that was permitted. It would be something that's unusual in nature and infrequent in occurrence. And infrequent in occurrence would be defined as something that is not expected to recur in the foreseeable future. And so in this case, because the event itself is the coronavirus, there's really, I don't think there's a basis for determining that, make the conclusion that a coronavirus wouldn't occur or recur in the foreseeable future. And GASB's actually explicitly addressed this in the technical bulletin as well. Because the coronavirus wouldn't meet the definition of infrequent in occurrence, you couldn't use the extraordinary classification as well. And then the special treatment really relates to those factors in combination with something that's under management's control. And of course, the coronavirus is not under management's control. So neither of those options are available for this treatment. And then on the balance sheet, it's relatively straightforward. Again, you're looking at a refund liability for those circumstances, as applicable. The one thing to note is on the balance sheet or the statement of net position, this wouldn't be a deferred inflow. It would actually be a liability. because there's an obligation associated with it, not just the passage of time. So it would be a liability, not a deferred inflow. And I think we have our next polling question, Emily.
All right, our next poll. Does your organization feel prepared for the potential single audit requirements related to the Provider Relief Fund? And your options are A, yes, B, no, or C, I'm not sure. And for those of you that would like a copy of today's slide deck, you can download from the folder that says slide decks and handouts to the left of the slide view. We will also be sending the slides via email after the webcast. I'll give everyone another moment here. All right, let's go ahead and take a look at the results. Back to you.
Great, thanks, Emily. Interesting kind of a spectrum there, Aparna, in terms of are we ready? Yes, no, maybe. Kind of covers the gamut.
Yes, thank you. With any luck, we'll hopefully get more clarity later this year, and more folks might be in the yes category. All right, so we're going to switch gears now and talk about the Fema Public Assistance Program. So this is, this program, the governmental and not-for-profit entities are eligible to participate in the program. The accounting treatment actually would be very similar to the PRF funds that we just discussed. They would be considered non-exchange transactions. And because these are also federal dollars, for those organizations that do receive these grants, those grants would be subject to single audit, so they would be part of the schedule of expenditures, the federal awards, and depending on the fiscal year. So for those that receive, the timing of when these funds are received, that would be the year that these would be subject to single audit. In terms of the accounting for this in timing and recognition, timing and amount of recognition, again, this would be similar to the PRF funds, but the timing actually might be a little bit different. Because these are expenditure-driven grants, basically the expenses have already been incurred at the time organizations are going to be applying for these funds. So the accounting treatment is a little bit more straightforward in that, when the grant or contract is executed, the transaction would be recorded as revenue and a receivable because the conditions have been met to be able to receive that grant. All right, next area we're going to talk about are the Medicare Accelerated and Advanced Payment Program. So just as a kind of a recap, these advanced payments were provided to organizations right when the pandemic started, and the program is set up that the recoupment period starts 120 days after the payment was received, with the idea that the full amount is due 210 days to a year following the advance. In terms of the accounting, we've kind of listed both the FASB and the GASB side of it. So for the FASB side, this would be identified as a contract liability, and excuse me, and similar to the PPP loans that we'll talk about, we've seen some information around that. And then as once the recoupment period starts, as those services are provided, the liability gets amortized into revenue as and when the services are provided. And based on how the volume of services provided relative to the amount of the advance, at the end of that recoupment period, there is a possibility that there could be a potential transition from a contract liability for the FASB reporters to a refund liability, because there could be potentially an amount that may need to be repaid back to Medicare. In terms of the GASB side, again, this would be considered an advance liability, not deferred revenue or a deferred inflow. And same concept in terms of once the recoupment period starts, amortize that liability into revenue as the services are provided, and then at the end of the recoupment period, consider whether there's potential that this needs to be transitioned into a refund liability. So another thing to note here, I think I mentioned earlier that some entities have concluded that this could be a loan similar to the PPP. However, the accelerated payments, the program is not new. It's just CMS just expanded the regular payment program, and so they're still based on the contract year for organizations and the reimbursements that's put into those contracts. So that's why we think it's more appropriate or more likely that these should be considered as advance payments, and then the accounting that we discussed. All right, so moving on to the Paycheck Protection Program loans. So I'm not sure how many of our attendees that are listening to organizations have received these loans. Just a high-level update, snapshot of the program. The loans are forgivable if certain criteria or conditions are met by the borrowers. There are defined loan terms and promissory notes that have been, executed by the organizations that are receiving these funds. The AICPA did just recently, as well as the GASB, they did release a technical Q&A that addresses the accounting treatment for this. And I'll start with the AICPA or the FASB side of things. Generally, we're expecting to see the loan accounting for this, or debt accounting. So there would be, the interest would be accrued on that liability or that principal under FASB 835 or GASB 70. And there's no additional interest that would need to be calculated on that. And then down the road, when organizations have applied for forgiveness, that liability, the debt that's been recorded, would then be converted into a gain on forgiveness of debt. But that has to be when there's documentation that the organization has legally been released from that obligation, and that there's legally been, the forgiveness has been granted. This is the only option for GASB reporters, so there's no flexibility in how this needs to be accounted for, and the timing of when that gain might be recognized is going to be based on facts and circumstances for each organization, and what the information might be that they have to be able to conclude on that. In terms of another potential option for FASB reporters, there is potential for this to be considered a grant treatment. So this is similar to what Brian had discussed about the PRF funds for the private entities. However, I think the burden here that needs to be met in terms of documentation is, under the debt accounting, it's a little bit more straightforward that the debt is removed from the financial statements once that kind of legally binding restriction, forgiveness has been provided. And so under the grant treatment, organizations would need to make sure they have sufficient information to show that, based on the facts and circumstances, it's very probable that the forgiveness would be granted in order for the grant treatment to be appropriate. And so, little bit more of a conservative approach would be to show it as a loan and then convert it into a gain once the forgiveness has been granted. All right. Next up is the temporary increases in the CMS payments. And then here, just high level, some of the provisions are the sequestration was suspended. There's been rate increases related to COVID-19. The dish cuts were also suspended. And then the last one is really the PRF funds that we've talked about, and related to the uninsured pool. And the one thing to highlight here is with the uninsured pool, these particular funds would be considered an exchange transaction. So unlike the PRF funds we talked about before, these would be considered an exchange transaction. So these would be accounted for just basically as part of net patient service revenue, part of the reimbursement, for the provision of services. And for those FASB reporters that have adopted and implemented ASC 606, there would need to be kind of the corresponding adjustments or changes made to the explicit price concessions or contractual adjustments. One thing also to note is the balance billing is prohibited, so any changes from this should not impact your implicit price concessions or provision for bad debt. All right, Brian, I believe it's back to you. Oh, actually, just kidding. This is for me as well. One more slide here that I just wanted to cover is just some of the accounting resources that are available out there. So, there's, as I mentioned before, there's some technical Q&As that the ASCPA has been issuing. So we talked about the PPP one. There are others in the works. GASB has issued their technical bulletin that Brian had referred to. There's also several alerts and articles that have come out from the ASCPA and the HFMA, the PNP board, that are hopefully shedding a lot of light and just providing some insight on all of these topics. And then lastly, we also have the firm, Moss Adams has also issued several papers and insights that can be Googled and found. And also if you go to our Moss Adams website, there's a lot of information there that can be found that can be of help as well. All right, so we have one more polling question, and Emily, I'll turn it over to you.
Thank you. Our last poll today, where do you feel is the most complexity in terms of understanding the requirements and maintaining the necessary documentation? And your options are A, provider relief funds, B, Fema funding, C, Medicare accelerated and advanced payment program, or D, the Paycheck Protection Program loans. And I'll give everyone a few seconds on this last poll here. All right, let's go ahead and take a look at the results. Back to you.
Thanks, Emily. So looks like a little bit of a mixed bag, but people are primarily focused on the provider relief funds, Brian. So hopefully there'll be more guidance coming out there that will help everybody.
Yeah, no, we knew coming in that was a significant issue from an accounting perspective out there, Aparna, right? And we have a ton of questions. Well, hopefully we'll be able to get to those. I know we have gotten to many of them during this session, but a lot of those questions are around the actual working conditions and terms, et cetera, related to the provider relief funds and guidance that HHS has or has not yet put out. And we're all in the same boat there. That creates an issue in accounting for these when we have good guidance. So, interesting. Well, let's get to just a few other accounting considerations that I think you might be thinking about or want to think about here, and that COVID-19 could have an impact, how that's impacting your organizations and have an impact on the accounting areas. So the first one is prepaid health care service contracts, or just health plan accounting in general, and the concept of loss contracts or premium deficiencies. So there's provision in the guidance for when medical cost expenses exceed premiums for the remaining period of a non-cancelable contract. In those circumstances, you're required at the end of a reporting period to accrue the estimated loss in the period that you make that determination. There's likely to be a loss on those contracts. So the AICPA ANA Guide, Chapter 13, it has that covers managed care contracts in general, has a really good section on accounting for loss contracts, and that's talking about FASB ASC 954-450. So that's a good resource there. But the concept behind that, again, is if you have a period in a contract that your expected expenses is going to exceed the premiums, you're required to accrue that back into an open financial statement period in which you make that determination. So as you think about the progress of the pandemic, you very well may have that circumstance here, particularly if you're a June 30th year end, and you think about the significant drop in utilization from March to March, April, and into May and June. You may have people that are prohibited, patients that are prohibited from utilizing services or that have chosen not to, and so you have this buildup of services, and if you have a contract that, say, ends on December 31st, and you would expect that all of those services that have been foregone in the second quarter of the calendar year, for those patients and customers to come in and access those services in the third and fourth quarter of the calendar year, you may have a situation where you have significantly higher utilization in the second half of the year, and those expenses for providing those services are going to exceed the premiums, the fixed premiums that you're receiving under that prepaid health care services contract during that period. And if you determine that that's the case, you have to estimate that difference and record that back into the period that's going to end June 30th, 2020. So it very well may be the case that because of the unusual utilization patterns that you see here in 2020 that you end up in that situation. So you're going to want to think about that and evaluate that closely. And again, there's some guidance here in the third bullet point that will show you where you can see more detail on that. And additionally, for those kinds of contracts and those entities, risk-bearing organizations, health plans, et cetera, or if you just have that kind of risk contract as a provider, your medical expenses, your medical cost IBNR accrual may be a little more tricky here, especially if you're June 30th year end. As you start to think about how those get evaluated, you look at claims over a period of time, historical claims that allow you to project what that IBNR might be, and you're going to have a significant potentially decrease in utilization there in the spring period, and how that impacts your IBNR accrual is going to be something you want to think about. It's likely that that might push that down, the IBNR accrual, at the end of the year, but the data that you're looking at for an entire period may not pick that up comprehensively. So work with your actuaries on that, just something to be aware of as you think about that. The next item we wanted to cover is debt covenants. So, obviously given what organizations are working through and the economic crisis, the suspension or prohibition on elective procedures, et cetera, it's been a tough year, and so I know many more organizations might be struggling currently with debt covenants in their lending agreements. I know, lenders generally have been very proactive on working with organizations on those, but as you have those conversations, you want to think about the impact of financial reporting. So if you have a debt covenant violation, and the remedy in the lending agreement allows the lender to accelerate the debt, so you have basically callable or due on demand debt because of a covenant violation. And I'm assuming this is all familiar to the participants on the webcast here. But in that circumstance, in order to maintain the long-term classification of the debt, you will need to get that covenant violation waived or the credit agreement amended in some form or fashion. So if you're looking for that waiver, you have to have that waived, or the creditor has to subsequently lose the right to call the debt for a period of 1 year beyond the balance sheet date. So that's really important for classification purposes, to make sure that the waiver of that right of default, or the right to call the debt, is in place for 1 year beyond the date. So if you have a June 30th year end, your waiver is going to want to be through June 30th or July 1st, 2020. It's really important from a financial statement presentation perspective. If you don't have that, then all of that debt gets shown as current, and that certainly has other implications. So a reminder there as you're having those conversations with your lender. And then finally, we want to talk just briefly about going concern. The concept that your financial statements are prepared under the assumption that the organization is going to continue as a going concern in perpetuity. When there are circumstances that raise substantial doubt about that ability to continue as a going concern, that has accounting and disclosure ramifications. So we wanted to, again, bring that to your attention because the guidance on that has changed relatively recently in the last 2 or 3 years on that. And it used to be, going concern used to be kind of an audit thing. Your auditors would assess that, and that would have an impact on disclosure, but it's primarily the impact is in the audit report. Do you have a report modification for that? Guidance came out from FASB, and I think it was adopted by GASB. How GASB handles that, but that explicitly put that evaluation into the accounting guidance. So it's management's responsibility to evaluate that as part of your financial reporting. And that guidance clarified how you would evaluate substantial doubt and whether substantial doubt exists. So you're going to want to evaluate that, and there's a couple of key factors here. One is that you need to evaluate whether conditions or events, and there's a bullet down here that lists what those might be. If those exist, you need to evaluate whether in aggregate they raise substantial doubt about the entity's ability to continue as a going concern for 1 year within the report issuance date. So if you're a June 30th year end and you're issuing your financial statements in November, you need to evaluate going concern for the following November 2021, as opposed to June 30th, 2021. You have to take in that extra period all the way through the report issuance date. So it's important to consider that timing when you're evaluating that. And substantial doubt is defined in the guidance as circumstances in which it's probable that the entity will be unable to meet its obligations as they come due. So that's the threshold that you have to get to in order to have substantial doubt. And then you evaluate whether there's mitigating factors there. So hopefully you will not be in a position where you end up having substantial doubt, but working through those considerations I think are going to be important and can be a little bit different this year than they may have been in previous years with organizations. And of course, you want to work with your auditors as they'll be doing that. Assessment will be important to them as well. So those are the items that we wanted to cover. I know we have a few minutes here for Q&A, and we have a ton of questions, and a lot of those have been answered. Before we get to that, we just wanted to highlight some resources that we have here on COVID-19 and articles and webcasts, et cetera. This will be in your materials when you download those. Those are live links. And as Aparna mentioned on a previous slide, from an accounting perspective, we've issued a number of things, but a number of other firms have as well. And so there's a lot of detailed guidance out there for some of the concepts that we've talked about. So take a look at what we have, and also use that Google machine or your favorite search engine. You can find some more detail on what we've been talking about here today. So let's look at some questions, Aparna, that we have here. I know we've had a number of those that we've responded to directly. Many of them were kind of thematically. There's been a lot of questions on specifics around terms and conditions from HHS. What is included or excluded from lost revenue, for example? How is that calculated? Again, we don't have all the details there related to that. But as you're thinking about that from an evaluation of whether conditions have been met, I would think about that from a cushion perspective. If you start to evaluate lost revenues on a common sense basis, how you would do that compared to the same period of the prior year, or compared to what you would expect from a budget perspective, if you had additions to capacity, et cetera. Start to take that number on lost revenue, which is substantial for most organizations out there, and compare that to what you've received. If you've got a significant cushion in there, and remember, you have to consider other funding sources, that gives you, I think, some comfort on recognizing that revenue, evaluating that, understanding that HHS has some work to do to define what that is. We also have some questions on reporting, and if we have detail on what that Hhs quarterly reporting is going to look like, and we don't. Again, the Hhs website has FAQs that are being updated pretty consistently, so that's a great resource there for that. Aparna, I know we had a couple questions on single audit that you were able to answer in terms of if this were subject to single audit, how that might impact an organization's single audit, especially if they're already having one. I would expect that these funds are going to be significant for organizations, so they're likely going to qualify as a major program.
Yes, and I know one of the attendees had asked, relative to some of the other programs that are already reported, the dollar amount may be not as significant, but depending on what guidance comes out later this year, these funds are likely going to be, if they don't meet the threshold for a Type A for an entity, they likely would be a high-risk Type B because, again, it is a new program, and the dollar amounts are going to be, we're expecting, relatively significant for most of the organizations. So odds are very good that these funds will end up being part of the major program determination of what programs would be audited under the single audit. Brian, we do have, switching topics again a little bit, going back to the PRF, there were a couple of questions around the lost revenue, and I thought we could maybe just expand on that a little bit for everybody's benefit. One of the questions was, does it have to be both lost revenue and the healthcare expenditures, or could it just be lost revenue? And the other part of that, could lost revenue be from non-healthcare sources? So for our organizations that are assisted living or independent living organizations, would that qualify in terms of the lost revenue criteria?
Yeah, it's a great question. I don't know that we have the complete answers out there. I think that's going to require some clarification from HHS on that. That question of and or has come up a couple of times at the AICPA level in terms of, are we looking at combining lost revenues and expenses, or do you take one or the other when you're evaluating that? And so that requires a little bit more clarification from HHS. Again, if you're looking at organizations that have significant cushion in their lost revenue compared to as they would calculate that logically compared to what they've received in provider reimbursement funds or provider relief funds, then I think you've got some additional comfort there to be able to recognize that revenue. If you start to bump into that upper edge there, it may be worthwhile to get some additional clarification on those items from HHS. And same with what rolls in specifically into lost revenue, Aparna, whether certain other sources can be included in there. Again, I think HHS has commented on the concept that when looking at lost revenue, there'll be a comparison with revenue in the current period versus the similar prior period, would be a measure of lost revenue. But there's also a concept that if you had expanded capacity, if you had additional beds, additional facility, et cetera, you would expect to have more revenue in the current year relative to the prior year, and so those kinds of considerations would likely roll into your calculation of lost revenue. But a lot of that is to be determined, and how you evaluate whether you've met the conditions. I think a lot depends on how much cushion you have relative to those current calculations.
Great. I think we're at time. Oh, go ahead, Brian.
I was going to say, yeah, we're right at time. I did want to address before we, and we'll go ahead and get to the questions that we haven't responded to. We'll respond to offline. But we did have a question I thought was interesting here, Aparna, on the PPP loans. We had a question come in that said, hey, would talk a little bit more about liability accounting. I was assuming that this would be treated as a debt instrument. I'm sorry, this relates to the Medicare accelerated and advance payments. I was thinking this would be accounted for as a debt instrument. We've heard that a number of times, that organizations are considering accounting for that as a debt instrument, as a similar to the PPP loan, as opposed to just kind of an advance payment from Medicare. And because the way the Medicare program works, where you have advanced and retroactive payments are an ordinary component of that program, and this advance payment scheme was really, I'm sure scheme is the right word, but it's really a mechanism that was already available. It was just expanded. I think we believe that the accounting for the advance payments as a liability and then relieving that into revenue, as a component of advance payment for future services, is more appropriate than accounting for it like a loan from the government. Similarly, I think there's really factors that make those two different kinds of instruments. But that answer has taken us over, Aparna, as you noted. We're at our time. I appreciate everybody hanging in there. We know there's some other questions out there that we'll try and get to, and some questions that just we're waiting for additional information. But we hope everybody found this to be helpful. And if you have other questions, don't hesitate to reach out to us, and we'd be happy to chat with you. Thanks for listening. We appreciate it very much.
All right.
Thank you. Emily, I think back to you.
Thank you. Again, thank you, Aparna and Brian, for a great presentation today. As we mentioned, if we weren't able to get to your question, we will be doing our best to follow up with you after the webcast. You may also reach out directly to Aparna or Brian using their contact information here. And I wanted to remind everyone to visit our slide deck and handouts widget for other Moss Adams COVID-19 resources. And here is a link to an online survey where you can provide feedback for today's presentation. Please take a moment to complete this survey, as your feedback is very important to us. Thank you for joining us, and we hope you'll join us again next time.